Well, we aren't the 51st state yet, and tariffs are on hold for now. But let's not act like we're in the clear. 2025 has already been throwing curveballs. We're less than 2 months in. Between rising inventory, mass mortgage renewals, and sudden surge in new supply, Calgary's real estate market is shifting faster than expected. In today's video, we're going to be covering a lot of local and macro subjects like, is Calgary finally entering into a balanced market, Canada's immigration reset, the US tariffs, and mortgage renewals. Let's get into it. First off, Calgary's market update. The shift has definitely begun. January's numbers just dropped and we're seeing a market that's rapidly changing. Sales were down 12% year over year in January, which means that demand is softening. New listings surged 35% year over year. And that's the biggest start of year jump since 2015. Active listings exploded 70% compared to last year, meaning that we're finally seeing a break in the inventory drought. But the benchmark price still hit 583,000, which is up 2.8% year over year. But let's get real. If inventory keeps building this fast, price growth will stall and some segments could dip. But we've seen this before. If new listings keep climbing and demand doesn't pick up, we could tip into a buyer's market within months. What we're hearing from a lot of sellers right now is overconfidence. A lot of sellers are chasing peak prices instead of pricing to sell. And that's why we're seeing months of inventory almost double, with homes taking a lot longer to move. But here's the reality. Spring 2025 will decide where the market is truly heading. A lot of our comments and my investors and buyers, they want to know what would need to happen for real estate prices to drop 5, 10, 15, 30%. So these next three factors are important to consider and could shift real estate prices by double digits, and not just with Calgary real estate, but throughout Canada. We've been talking about Alberta's population boom for years, but what happens when the boom slows down or stops? Because we have seen that in the past. Alberta's population grew by 3.8% last year, and that's the fastest in Canada. Calgary's median home prices are up 36% in the last 4 years, making it harder and harder for new buyers. And now Canada is cutting 2 million non-permanent residents over the next 2 years. That's 5% of the country's population gone. So what does that mean for the housing market? Well, rental demand is already slipping. Calgary's vacancy hit 3.1%, up from 2.3% last year. Average rents also dropped 2.1% month over month, and that's before the 150,000 plus new rental units hit the market in 2025. Now let's zoom into Toronto, because this is the warning sign. Toronto's new listings just jumped 49% year over year. Power of sale listings, or forced sales, surged to 331 in January. That's more than double last year's numbers. And unemployment in Toronto and Vancouver is at a decade high outside the pandemic. Translation: Toronto's condo and rental market are already cracking. And if you live in a high NPR city, you need to pay attention. If the population cuts continue, we're going to see higher vacancies, more listings, and lower prices in certain segments. The US is still floating a 25% tariff on Canadian goods, and if that goes through, expect a ripple effect that will drive construction costs up fast. Lumber and steel could see a spike by 15 to 20%. Between April 2020 and May of 2021, lumber prices surged 6x during the last major supply disruption. Historically, any trade war has led to double-digit price increases in construction materials within 3 months. But why does this all matter? Higher building costs don't just affect new homes, they make resale homes more attractive and push their prices high too. But here's what most people don't understand. Real estate agents like myself, we don't want prices to keep climbing forever. Cheaper homes equal more buyers in the market. More buyers equal more sales volume. More sales volume, a healthier market for everyone. If the prices keep spiraling up, the correction later could be much worse, and if tariffs reignite inflation, the Bank of Canada might have to hold higher rates for longer, squeezing affordability even more. Honestly, this is probably the most important factor. The mortgage renewal crisis is the biggest hidden risk in real estate right now. Over 50% of Canadian mortgages will renew in 2025 and 2026, and this is what we're looking at. The average mortgage payment will jump 35 to 40% on renewal. Variable rate mortgages made up 26% of new loans in January, meaning people are betting hard on rate cuts. Even with rates down 2% since last June, most Canadians will still see a large payment increase. And keep in mind, this isn't just a Toronto or Vancouver problem, this is a Canadian problem. If homeowners can't afford their payments, they're gonna list their homes, and fast. We've already seen signs of this. Toronto new listings are surging, Calgary's active inventory is at a 4-year high, and power of sale listings in major cities are up big. Bottom line, if you're renewing soon, get ahead of it now. Talk to your lender, explore your options, and don't wait until it's too late. Calgary's market is at a crossroads, and the next 6 months is going to set a tone for the rest of the year. Supply is flooding the market, but when we look at long-term trends, we're still in a seller's market. Immigration cuts could slow down demand faster than expected, but Calgary still remains one of the top cities in Canada. US tariffs could drive up costs, making homes even less affordable, but unfortunately, this is a factor that's going to change week to week, and we just have to monitor the situation. Mortgage renewals could force more sellers into the market, but fortunately, majority of Canadians that purchased a home between 2020 and 2022 still have a ton of equity. This isn't the housing bubble of 2008, but if you're waiting for prices to drop, pay attention to the trends. The best advice I can give to buyers right now is take your time. Deals are coming and there's deals here right now. No one can time the market. There are plenty of buyers and investors who thought the market would go down 50% back in 2020. For the sellers out there, price realistically. If you look at the home sale prices over the past 90 to 120 days, it's a lot more accurate than looking at last spring's numbers. Investors should be hyper-focused on vacancy rates and rent trends. If you invest in an NPR-heavy area, watch the numbers very carefully.